All right, in this video we're going to go over some of the things you already learned for inter-entity transactions, and then we're going to talk about some of the things you're going to go through in completing your homework assignment for this week. So in particular, what we're talking about is consolidation of inventory, sales, cost of goods sold, operating expenses, and part of your homework is going to ask you to calculate net income attributed to non-controlling interest. We're not going to talk about that in this video, so we're going to focus on just the first four, and then in another video we'll talk about net income attributed to non-controlling interest. Now, we're going to review some of the things that we've already learned, and some of the things that we already learned with this idea of consolidation. So at the very base level from a consolidation standpoint, it's pretty simple. All we're going to do is we're going to take the balance sheet of the parent, trial balance of the parent, trial balance of the subsidiary, combine their numbers, and then we're done. Now, that's from the very easy, simplistic way of doing it. What creates a little bit of confusion and what creates the mess of a work for consolidations is the entries that we have to make on the consolidated worksheet. Remember, we prepare a consolidated worksheet to eliminate transactions or add transactions that should have happened due to the consolidation. So an example might be that we bought this subsidiary, and in addition to buying the subsidiary, we bought their equipment, but we bought their equipment at fair value. They have it on their books for $100,000, but it's worth $200,000. So we're going to pay more for them than their book value, but we're going to allocate $100,000 extra of that excess in payment to that asset. So thereby acquiring that asset at fair value rather than at book value of $100,000. Well, in our consolidation entry, what we're going to need to do is step up the basis of that asset in our final financial statements, and the way that we do that is through a worksheet. Now, the thing that we learned in this chapter has to do with inventory assets and making sure that we eliminate transactions in which the intra-entity happens. And so what an example might be inventory. If a parent sells a subsidiary inventory, we have to eliminate that transaction as if that never happened unless that inventory has been sold to a third party, because related party transactions have to be eliminated in our consolidated financial statements. The same is true when we talk about assets. And so, for instance, if, let's say, a parent has this piece of equipment, sells it to the subsidiary, we have to defer any gains or losses from the sale of it until that equipment is subsequently sold to another company, okay? And we get that, the reason we do that is because a company itself cannot sell itself the same piece of equipment. If they did, or if they could, they can inflate gains or losses based on the selling price. In addition, the company cannot sell its own inventory to itself, because if it did, they can manipulate sales revenues and cost of goods sold just by selling that inventory back to themselves. So we have to eliminate that, because in a consolidation standpoint, the parent and the sub are one company, not two separate. Okay, and so that's what we're trying to do here. That's what we've been doing. Let's take this to kind of a review of consolidated balances and making consolidations. So in this chapter, we learned this idea of Consolidation Entry TI and Consolidation G. Let's go through Consolidation Entry TI for a moment, and we're only concerned with what's in black. We'll talk about what's in blue when we actually do some problems here. But when we do Consolidation Entry TI, that is the removal of the sale between intra-entities. And we're talking about inventory, but this could mean other types of assets as well. But for this case, inventory. So we're trying to remove the sales revenues of inventory between a parent and a sub, or a sub and a parent. The way that we do that is we debit sales revenue, because that removes the sale, because if we had a sale, we would credit sale. If we're debiting sales, it would remove the sale. And we are also crediting cost of goods sold. Normally, we would debit cost of goods sold. In this case, we are crediting cost of goods sold, which would bring down cost of goods sold, therefore deferring that profit that would have happened. Okay. So that's what we're doing in Consolidation Entry TI. Now, Consolidation Entry TI is fairly simple. All we need to do is figure out how much did the parent sell to the sub, or the sub sold to the parent, and that amount would be what goes here. So to walk you through an example, let's assume that Mickey owns Donald. So Mickey is the parent, Donald is the subsidiary. They have some numbers here. We'll go through them later. But that Mickey sells Donald, so Mickey sells Donald $80,000 worth of goods, and that's Mickey's cost, that now costs $100,000 to Donald, okay? Well, Mickey is going to debit cash or accounts receivable and credit sales. Well, we need to remove that sales, and to remove that sales, we would do Consolidation Entry TI. Okay, and so what do we have here? Well, we've got a $100,000 sale that has to be removed. So what we would do in Consolidation TI is we would debit sales revenues for $100,000, and we would credit cost of goods sold for $100,000. Okay, now that would remove the sales revenue. At the end of the day, this entry just removed the sales revenue. We're not really concerned about cost of goods sold. We'll be concerned with cost of goods sold over here in Consolidation Entry G, but at the end of the day, it also removes the cost of goods sold here by crediting it, because normally cost of goods sold we would debit. Okay, so that's Consolidation TI. Now, we also talked about Consolidation Entry G, and the purpose of Consolidation Entry G is simply to defer the profits. Okay, what are we talking about? So when Mickey sells to Donald $100,000 worth of goods, okay, at their cost of $80,000, there's $20,000 of profit. Well, in consolidations, we know that we're not allowed to book those profits, and we must defer them until subsequently Donald sells that inventory to a third party. Well, if they haven't sold it to the third party, we need to defer the profit. So for instance, let's say, and we're not going to go through this equation or this problem right here yet, but let's say that at the end of the year, Donald has sold half of the goods that Mickey sold to Donald. So in essence, Donald has sold $40,000 cost basis or $50,000 sales basis of Mickey's goods. So in this case, we would right here have a $20,000 profit, but because we've already sold half of it, it's as if we would have to defer $10,000. Why? Because we sold half of it, so we would assume that $10,000 of profit has been earned because it's been sold to a third party, but the other $10,000 hasn't been earned because it hasn't been sold to the third party, so we would have to defer $10,000 in profit. Okay, now for our example here, let's assume that at the end of the year, Donald has 25% left, and so the question is, how do we calculate the gain deferral? Well, we would take that 25%, multiply the sales, and we get $25,000. Now remember, in our last couple of videos, we talked about gross profit margin. What's the gross profit margin? How much profit do we normally make? Well, if we use gross profit margin, we would take profit divided by sales, so profit would have been $20,000 here, 100 minus 80. That would get us our 20. We divide by 100,000, which is sales, and that gets us a gross profit margin of 20%. So if we have $25,000 worth of inventory left, if this is Donald's cost, okay, at a gross profit margin of 20%, we're going to defer $5,000 of gain. Okay, so simply put, we take 25% of sales because that's what's left, and really sales is Donald's cost, okay, but that's the number that we typically use when we're calculating this deferral profit, okay. So we take 25% of that to get 25,000. We multiply it by a gross profit margin. In this case, gross profit margin of 20%. 25,000 times 20% gets us $5,000 of a profit deferral. So Consolidation Entry G tells us that we will debit cost of goods sold for $5,000, and we will credit inventory for $5,000. Okay. Now you might say, why are we increasing cost of goods sold by $5,000? Well, we're increasing cost of goods sold by $5,000 because we're creating more of an expense. If we create more of an expense on the financial statements, it's as if the profit decreases, which is deferring the profit, right? If we can decrease the profit, we're deferring the profit at the end of the day. So by doing this, let's say net profit was $70,000. Well, that would have been the profit, but we need to defer 5,000 of that profit. Well, how do we do it? We increase cost of goods sold. So by increasing cost of goods sold, we've got $5,000 of an additional fake expenses, and we now have $65,000 of net income. How we defer the 5,000? Yes, we've increased cost of goods sold. So that's why we do this right here, okay? Is we are literally increasing the expense a little bit more in order to defer the profit. Okay, so now that we've gotten that out of the way, let's talk about consolidating these entries. Okay, so walk with me here as we do this so that you'll understand it more. So let's talk about inventory for a moment. Normal procedures say that we add up inventory of the sub and the parent, and then we're done. Okay, so here's Mickey, here's Donald, here's their trial balances or condensed trial balances. Mickey has inventory of 700,000, sales of 1.35 million, cost of goods sold of 800,000, and then operating expenses of 210. Donald has inventory of 350, sales of 425, cost of goods sold of 175, and operating expenses of $95,000. Okay. Now, in addition to that, we have some equipment excess, and remember what we're talking about here in the equipment excess is that Mickey bought Donald out, and by buying Donald out, Donald probably had some assets that were undervalued. Why were they undervalued? Well, he was taking depreciation, but the fair value was worth more. Well, when Mickey buys Donald, he's not buying the equipment at book value. He would love to buy it at book value, but he's going to buy it at fair market value, because at the end of the day, if you're Donald and you have a $200,000 piece of equipment, however, it's on your book for $100,000, you're not going to sell it to Mickey for $100,000. You'll rather just take that piece of equipment, sell it out to a third party for $200,000, and then you'd have $100,000 more than what Mickey would have given to you. So in order to avoid that, Mickey has to pay you $200,000 for that equipment. Well, remember we said that the excess over book value of a company that we pay, we allocate first to the underallocated assets based on fair value, and then the rest to goodwill. Okay, so that was a few chapters ago. But in this case, let's assume that there was a piece of equipment that was on Donald's financial statements for $100,000, and let's say it was worth $400,000. So the excess would have been $300,000. If you remember from our previous talks with the equity method, what we do is we take the rest of its life. So let's say this equipment has 10 years left of life, and we amortize that over 10 years. We don't depreciate it, we amortize it. So what we're going to need to do is we're going to need to do a consolidation entry to have an excess expense of $30,000, because we're saying that we're allocating $300,000 to equipment. We're going to divide that by 10 years, which is the whatever's left life of that equipment, and we get $30,000. That's considered excess amortization, which means we need to book an excess expense of $30,000 per year. And then we've already talked about the inventory, and we've already completed the inventory amount, so that should be good. So let's start with inventory, and let's conceptually look at what we have here. We conceptually have a T account here, and obviously these two inventories would have been a debit on both Mickey's and Donald, so we would transfer that here, and we would get $700,000, okay, and we get $350. And if you can't read it, I apologize. So that's $1,050,000. Okay, right? Yeah, $1,050,000. So that's what we have on the inventory. But what entries did we do over here? Oh, well, we've got an inventory here of a credit of $5,000. So this would be our consolidation entry. That would be a credit. We would credit here $5,000. And so our combined inventory consolidated balance would be $1,045,000. Okay, so we combine these $1,050,000, and we bring down the deferral of our profits by $5,000 of inventory. Well, we credit inventory by $5,000, so that brings our consolidated balance for inventory of $1,045,000. Okay, so logically, that's what's happening. Okay, we could have just added here, and then you could have just subtracted there, but I wanted to show you as a T account what does it look like, because that's why we're doing it. Okay, next thing, sales. Okay, well, again, same idea here. Sales are normally credits, so we will credit all the accounts. I've got $1,350,000 for Mickey, and Donald had $425,000. Okay. So we'll add that up. $1,775,000. Okay, that seems good and all, but we had some reversals of sales. Well, our reversal of sales right here says that we're going to debit $100,000. So let's debit $100,000. Okay, so when we go bigger minus smaller equals bigger, we get sales of $1,675,000. Okay, so $1,675,000 would be our consolidated sales. How did we get to that? We added our sales, we subtracted what we had here in sales revenues. Okay, so easy enough, right? We can keep on going here. Cost of goods sold here, and I'm going to erase this for a second here, just so that we can, maybe not, just so that we can see what's going on here and get some more board space. So cost of goods sold, we can do the same thing as we've done before. Cost of goods sold typically is a debit, so $800,000. Okay, and then cost of goods sold for Donald was $175,000. That gets us $975,000. But wait, we've got two entries over here. We have a credit of $100,000, and we have a debit of $5,000. We add that up together, I get $980 minus 100 gives me $880. So our consolidated cost of goods sold is $880,000. How did we get there? We added our two cost of goods sold, $800,000 and $175,000. That gets us $975. We had a credit of $100,000. That brings it down to $775. And then we add back $5,000. Wait, did I say that right? So $975 minus $100,000 gets us $875, and then we add back $5,000 to get $880,000. So that's how we get to the consolidated balance for cost of goods sold. Now, operating expenses. Now, this is a little bit tricky because this takes you all the way back to like chapter 2, and so we might not remember it. But for operating expenses, what we're going to need to do is we're going to add up all the operating expenses, but we're also going to need to take into account things like excess amortization, okay, or anything else that we have to expense even more. We also take into account any issues where maybe this is the year in which they were acquired, so we had $10,000 of additional expenses to issue more stock or whatnot. We'd have to include that. In this case, we don't have anything like that. We have simply excess amortization on the markup or the step up basis of Donald's assets or equipment from when Mickey bought Donald. Okay, so first of all, again, same thing. We add up our operating expenses together. So I have 210 plus 95 gets me 305. Okay. That would be our operating expenses, but we have this excess amortization of $30,000. So what we do in this case is we add that as an additional expense. Remember, that $30,000 doesn't go on the parent and doesn't go on the subsidiary because of the equity method. The equity method says we don't do it. We just do it as a consolidated entry at the end of each year for the next 10 years. So we increase this cost of goods sold by $30,000, or sorry, this operating expense by $30,000, and we get $335,000. Okay, so what we've shown you here is how you would consolidate balances for inventory, sales, cost of goods sold, and operating expenses when we have intra-entity transactions, okay? So this chapter is all about intra-entity transactions. In this video, we covered these 4 accounts and how we get to it. How we get to it is by using what we already know. What we already know is that we do a Consolidation Entry TI. We also do Consolidation Entry G. Once we've done those two, then we can use what we have here to then close up all of our T accounts here, which would give us our consolidated balances. So for this example, we have our ending inventory of the consolidated Mickey and Donald of $1,045,000. We have the consolidated sales of $1,675,000. We had consolidated cost of goods sold of $880,000, and then we had consolidated operating expenses of $335,000. All right, so that should get you through one of your problems that you have for this week. In the next video, we're going to talk a little bit about the net income attributed to non-controlling interest. So we're going to add upon this example here. In particular, one thing that we didn't discuss is how much does Mickey own of Donald? In this case, we assumed 100%. However, the only thing that changes here is that it's not going to be 100%. Nothing changes here, okay, which is why we're addressing it now. Nothing changes here even when Mickey owns less of Donald, okay? So nothing changes here in particular, but things will change here when we talk about net income attributed to that non-controlling interest. All right, so hopefully you understand that, and we'll see you in the next video when we talk about that one account, the net income attributed to non-controlling interest.